Sandy, you've identified a risk in the fallout from the Archegos collapse, and it concerns counterparties, the firms, the Wall Street firms largely, that investors like Man Group and others have to deal with. Tell me about this risk.
So the risk is really that there are just less counterparties to deal with today than there were 5, 10, or 15 years ago. That might be as a result of regulations, it might be as a result of competition, but what's clearly happening is, especially for prime broking services and other clearing services, there are fewer competitors today than there were just a few years ago.
We already know that Deutsche Bank, for example, has, over the course of those years, been pulling back from prime brokerage to a degree, even though it was one of the firms that did business with Bill Hwang and his firm Archegos. Are you thinking now that the damage to banks such as Credit Suisse, for example, and Nomura may shrink further the availability of counterparties to an investor like Man Group?
Yeah, I think it almost inevitably means that you will get a strengthening of the strong and a weakening of the weak, and some exits probably from the prime broking and other clearing services businesses, with the result that we have fewer firms to deal with. I don't think it's at a dangerous tipping point, but we certainly don't like the idea that there are less firms that we can deal with.
And you don't like the idea why? Because it gives you less negotiating leverage on things like fees, pricing, if you will? Or is it a diversification, robustness thing? What are the issues?
Well, it's both of those. It's clearly, the more competitive a business is, then the more you're going to be able to drive the prices down. You want to have multiple counterparties for everything you do, and so having more is always going to be better. But then I think the other thing is that even strong counterparties hit difficulties every now and then and can withdraw from businesses. And if you don't have enough, or you're getting an ever-reducing number, then you're just more exposed to that risk of somebody that you thought was strong no longer being strong and withdrawing. So as I say, I don't think it's at a dangerous tipping point, but we've been in a one-way move for the last 10, 15 years of just less, especially prime brokers.
Sandy, before the financial crisis, which seems like ancient history now, of course, Morgan Stanley and Goldman Sachs had something of a duopoly in prime broking. Are you concerned we're going back to those days?
I think, your words are well chosen, something of a duopoly. They're the dominant two, but they weren't the only two. And we've certainly got more than two today that I would consider strong. But a lot of the people that strengthened after the financial crisis seem to be withdrawing in one shape or form. And what you're also seeing, and I think it has affected us in other areas, is some banks, particularly some of the European banks, deciding not to be brokers in equities or not to be brokers in fixed income or something like that. And so you're getting really quite a small number now of banks that you could really consider full service investment banks. And that is problematic because for us, we really like to think of counterparties that can serve us across a very broad range of products rather than having a sort of pick and choose type of effect.
Sandy, entirely separate from the issue of counterparties is another question very much on the minds of investors in equities, and that is to say, can value continue outperforming growth as it did spectacularly in the first quarter and still has to a degree since the end of March?
Yeah, so I think, firstly, you're absolutely right. There was the spectacular outperformance. For those people that were able to stick with value investing, and the pain of value investing was pretty significant over a decade. So it was a long period of sticking with it. Those people that were able to stick with it had a fantastic first quarter. Actually, a lot of quant strategies in equities are very value focused. And so many of them had really strong returns in the first quarter. People might be saying, well, is that it? And I think I would argue it's actually very simple. You've had 10 years of underperformance of value names. You had 1 quarter of outperformance. That's a very small move back in the in the right direction or in the normal direction. And what you really tend to see in markets, if you look at them over very long periods of time, is that everything turns out to be cyclical. So you have these long negative cycles in value. It's not the first long negative cycle. And then often you'll have quite rapid reversals. To me, it looks as though we're just a short way through that rapid reversal. That doesn't mean there won't be bumps along the way. The reversal certainly has slowed down during April. But it does mean that there's a long way for this still to run, and that we shouldn't be thinking that this is the time to take off positions on value names.
Sandy, Man Group is largely, not entirely, but largely a quant manager. Is the value rotation a good thing for quants like Man?
It's certainly good for some parts of what we do. I would say that the more what I would call traditional quant equity investing, that tends to have somewhat of a value focus to it. It's easier in equities to determine value than it is to determine growth. But people often think that quant is one thing, and it's really not. It's hundreds and hundreds of different things. And so many of our strategies have absolutely nothing to do with value, and been having a very comfortable time when value has been doing poorly. So it affects one segment. It's been very good for that one segment, which had suffered, especially the last couple of years.
Sandy, you have flagged previously elevated volatility as a risk that may persist in equity markets for years. And risks, of course, are the core subject of the book that you've written, Strategic Risk Management. But I want to talk about another risk, and that is the risk which you also address in this book, and that is the risk of diversification failure. Many people have talked about the fact that the 60-40 portfolio no longer works because we're no longer in a bond bull market. It lasted for 40 years. It's over. What are the practical implications of that diversification failure, if you will?
Yeah, well, I don't think the diversification failure has necessarily happened yet, but I think we should be really attuned to it. And the failure, I think, could mean that, well, people, firstly, if they're not running 60-40, they're going to have to run something else. We've come across some investors that are running 80-20, for example, 80% equities, 20% bonds, which is a tremendously risky portfolio, especially if equities turn out to be riskier in the next 5 to 10 years than they have been for the last 20 years. So it is driving, the fear of rising bond yields is driving people into less diversified portfolios. So that's one observation. The second, though, is I think really the best way to manage this risk of do equities and bonds carry on diversifying each other is to try and build a risk management approach which allows you to really work out when bonds and equities are failing to diversify. And I would argue that to do that, you need to be really able to move positions fairly quickly in these periods. And the periods you're really worried about are when bond yields go up and they push equities down. And that's really not something we've had for most of the last, especially 20 years. Typically, you've had negative correlation between equities and bonds. When equities fell, bonds saved you, and that was your protection asset. But it looks to us as though the risks today that bonds fail to diversify, that's really something to worry about.